In September 2008, Lehman Brothers collapsed on a Monday morning. By Friday, the global financial system was hours from total shutdown. ATMs would stop working. Paychecks would bounce. Grocery stores would run out of food within days. That didn't happen. Central banks flooded the system with money, and the machine kept running. Here's what almost nobody talks about. The emergency tools that saved us in 2008 are now built into the system. They're running constantly, in the background, right now. And that's the problem. The financial crisis playbook has 3 moves: cut interest rates to zero, buy trillions in bonds, backstop the banks with unlimited cash. In 2008, these were emergency measures, shock and awe. By 2020, they were standard procedure. The Fed's balance sheet went from $800 billion to $9 trillion in 12 years. The European Central Bank bought so many bonds they ran out of things to buy. Japan's been doing this since the 1990s. Their central bank now owns more than half of all government bonds. They're the largest shareholder in the Japanese stock market. Not the largest investor, the largest shareholder. This isn't a conspiracy, it's published policy, and it worked. Sort of. Unemployment fell, markets recovered, headlines moved on. But here's the thing about medicine that becomes food. You can't stop eating it. Interest rates across developed economies sat near zero for over a decade. Then inflation came back. Not the gentle 2% kind, the rent is up 15% kind. So central banks did what they had to do. They raised rates. Fast. And now, the math has changed. Let's talk about what happened while rates were basically zero. Governments borrowed. Massively. U.S. federal debt doubled between 2008 and 2020, then jumped another $8 trillion by 2024. Most of that debt was issued at historically low rates, 2%, 1%, sometimes less. Companies did the same thing. Corporate debt in the U.S. went from $6 trillion in 2008 to over $11 trillion by 2023. Zombie companies, businesses that don't earn enough profit to cover their interest payments, stayed alive because debt was cheap. Private equity firms borrowed billions at 3% and bought everything: grocery chains, veterinary clinics, dentist offices, apartment buildings. Their entire model depended on one assumption: rates stay low and you can refinance forever. Then 2022 happened. The Fed raised rates from near zero to over 5% in 16 months, fastest hiking cycle in 40 years. Here's the uncomfortable part. That debt doesn't disappear, it comes due, and when it does, it has to be refinanced at the new higher rates. The US government is currently paying over $1 trillion a year just in interest. That's more than the defense budget, more than Medicare. It's the second largest line item after Social Security. For context, in 2021, interest payments were $350 billion. Corporations are facing the same math. Roughly $2 trillion in corporate debt matures between now and 2026. Most of it was issued when rates were under 3%. Now it's getting rolled over at 7, 8, sometimes 10%. If you're a company that borrowed $1 billion at 3%, you were paying $30 million a year in interest. Refinance that same debt at 8%, and now you're paying $80 million. Same debt, same business, $50 million more in interest every year. And that's assuming you can refinance at all. In 2008, the crisis started in the private sector. Subprime mortgages, over-leveraged banks, Lehman Brothers. The government stepped in to clean it up. This time, the government is part of the problem. When rates were low, politicians from both parties spent without consequence. There was no penalty for deficits because borrowing was free. Every emergency got a $1 trillion solution: pandemic relief, infrastructure, tax cuts, student loan pauses, all of it financed by debt. Nobody asked what happens when rates go back up, or maybe they did and just assumed they wouldn't. But they did, and now the interest payments are eating the budget. Here's the trap. If you're a government paying $1 trillion a year in interest, you have 3 options: cut spending, raise taxes, or print money and hope inflation doesn't spiral. Option 1 is political suicide. Option 2 is also political suicide. Option 3 is how you get Weimar Germany. There's a 4th option: You pressure the central bank to cut rates again, manufacture a reason, claim the economy is weakening, say financial stability is at risk. And maybe it is. That's the thing. With this much debt in the system, higher rates create the very crisis that justifies cutting them. It's a logic loop. In 2008, central banks saved the economy by expanding their balance sheets. This time, they might have to do it just to keep governments solvent. That's not a bailout, that's a dependency. Walk into any economics conference or read any central bank statement, and you'll hear the same narrative. Soft landing, inflation is cooling, the system is resilient. And on paper, it's true. Unemployment is low, GDP is growing, banks are better capitalized than in 2008. But look closer. The soft landing depends on nothing breaking. No geopolitical shocks, no sudden liquidity crunch, no cascading defaults in commercial real estate or private equity or sovereign debt. The system is stable as long as everyone believes it's stable. That's not resilience, that's confidence, and confidence is just a story we tell ourselves until something happens. In 2023, 3 mid-sized US banks failed in 1 week: Silicon Valley Bank, Signature, First Republic. The Fed and Treasury stepped in immediately, guaranteed all deposits, opened emergency lending facilities, crisis averted. But here's what didn't make headlines. Those emergency lending facilities are still open. Banks are still using them, quietly. In Europe, Credit Suisse collapsed and got absorbed by UBS in a weekend. The Swiss government backstopped the deal with over $100 billion in guarantees. These weren't 2008 scale events, but they also weren't normal, and they required the same emergency playbook. The problem with emergency tools is they stop being emergencies when you use them every few years. Markets are pricing in a return to lower rates. The assumption is central banks will cut as soon as inflation is under control, maybe late 2024, maybe 2025. But what if inflation doesn't cooperate? What if it stays at 3–4%? Not a crisis, but not the 2% target either. Do you keep rates high and watch the debt spiral, or do you cut rates and let inflation run? Both options are bad. That's the thing about traps. There's no good exit. In 2008, the crisis was contained to finance. Banks failed, mortgages defaulted, but the real economy, messy as it was, eventually recovered. This time, the debt isn't just in banks, it's everywhere. Government balance sheets, corporate balance sheets, household balance sheets, student loans, auto loans, credit cards, mortgages, all of it tied to interest rates that just tripled. And here's the kicker: debt is someone's asset. Your mortgage is a bank's revenue stream. Government bonds are pension funds' safe haven. Corporate debt is in every mutual fund and ETF. When debt goes bad, it doesn't just hurt the borrower, it ripples through the entire system. In 2008, the fear was contagion. One bank fails, then another, then another. In 2026, the fear is exhaustion. Not a sudden collapse, but a slow, grinding weight that nobody can lift. Japan's been living this for 30 years. Low growth, low rates, endless stimulus, an aging population, and a government debt to GDP ratio over 250%. It's not chaos, it's stagnation. The West looks at Japan and thinks that won't happen here. But the math is the same. The debt is the same. The demographics are moving the same direction. Maybe we get lucky. Maybe AI drives a productivity boom. Maybe inflation stays low and rates come down and everyone refinances and the debt gets manageable again. Or maybe we're just Japan with better marketing. The 2008 crisis was a car crash, sudden, violent, over in months. What's coming isn't a crash, it's a slow puncture. Governments can't afford the debt but can't stop borrowing. Central banks can't raise rates without breaking something, but can't lower them without risking inflation. Markets are priced for perfection in a world that isn't anything. And the emergency tools that saved us last time? They're already deployed. The bazooka's been fired. The ammunition is spent. Maybe that's fine. Maybe the system adapts. Maybe this is just the new normal. Perpetual stimulus, perpetual debt, perpetual intervention. Or maybe there's a limit, a point where the math stops working and the story stops holding. The thing about limits is you don't know where they are until you hit them. And we're still driving.